Australians love Australia. With our laid-back lifestyle, warm climate and unique landscape, why wouldn't we? It may come as no surprise when investing that Australians prefer to hold local companies by a significant margin. Despite making up less than 3% of the global share market, Australian shares made up over 2/3 of Australian investors' portfolios. In this video, we discuss how this favoritism could be costing you, and we also compare the beloved ASX 200 index with the US S&P 500. Let's get into it. Firstly, let's define home bias. It's a well-documented investment phenomenon that describes the relationship between a country's investors and its equity markets. In most countries, investors will hold stocks listed in their own country, disproportionately more than other nations. And this phenomenon becomes more pronounced for countries with a smaller economic footprint. We've used the example of Australia, but it's also true for Canadian, British, and Japanese investors. Each country places more weight on domestic stocks than the larger global market. Investors don't just do this because they think that their country is better than others' countries, although that could be a factor. The researchers who initially discovered this phenomenon hypothesized that we do this because information about international stocks are hard to access, whereas information about domestic stocks is easy to access. The issue with this hypothesis is that today information is widely available. I can learn about a stock listed on the New York Stock Exchange just as easily as I can learn about a stock listed on the Australian Securities Exchange, for example. The internet has removed this information divide. Another hypothesis states that investors feel more comfortable with local investments. It feels good to buy Commonwealth Bank shares if you bank with them, or buy Woolworths shares if you buy your groceries from them. Regardless as to why the home bias puzzle exists, Australian investors should be considering whether or not it's the right investment approach to have a large overweight allocation to Australian shares. Let's talk about some of the key factors that you should be considering when making this decision. And in order to do that, we'll be looking at two indices that already exist in many Australian investors' portfolios, the ASX 200 and the S&P 500. If you want a quick video primer on what an index actually is, check out the video here. The ASX 200 is home to many of Australia's well-known blue chip stocks, the big four banks, BHP, CSL, and Rio Tinto, for example. On the other hand, the S&P 500 index has gone through a number of iterations, but is currently dominated by large cap technology companies like Microsoft, Apple, Nvidia, and Amazon. Firstly, you should consider diversification. Diversification is a key problem when it comes to home bias. To quote French and Perturba, the first people to formally study the home bias puzzle, since the fortunes of different nations do not always move together, investors can diversify their portfolios by holding assets in several countries. Being overexposed to Australian shares means that investors are heavily tied to the performance of Australia as a country, how much external investment there is, how the price of coal and iron move, even things like the weather. So you should consider whether investing in global markets might help you diversify. Diversifying across multiple geographies can help reduce risk. An index like the S&P 500 is a good representation of US shares, but it's not the only geography to consider. You can diversify through geographies such as Europe, Asia, and emerging markets like Africa and South America. You should also consider whether or not your portfolio is diversified across sectors. Each sector carries with it its own unique risks and opportunities. For example, the financial sector often has a regulatory impact on the industry's operations. Agricultural goods can all suffer in the case of droughts. Sector diversification helps reduce the risk that challenges in a single sector will cause your portfolio to decline. A perceived problem with the ASX 200 is that it's dominated by the banks and miners, leading to a heavy reliance on financials and materials. Sectors like technology and utilities get little love. A similar case might be made for the S&P 500, which has the opposite problem, a 30% allocation to information technology companies. In instances such as these, investing in both indices can offer a potential solution where there is more diversification across different sectors. Next, investors should consider risk and return. In the past 10 years, the S&P 500 index has provided total returns of 15.28% per annum. Compare this to the returns of the ASX 200, which has provided total returns of 7.78% per annum in the last 10 years. However, the S&P 500 has proven a riskier prospect, Volatility sits at 15.29% per annum, compared to the ASX 200's volatility of 14% per annum. This risk-return relationship can be explained when considering the makeup of the ASX 200 compared to the S&P 500. The Australian market is dominated by large blue-chip companies. Australian blue-chip companies are mostly mature businesses with dominant positions in the market. This often means that profits made by the business are paid out to shareholders instead of being reinvested into new business ventures. Effectively, many Australian companies are already as big as they can possibly get, and this makes profit growth difficult, but this does mean they can better weather economic turmoil. Compare this to the US tech giants. These companies are consistently innovating, creating new products, entering new markets, and reinvesting profits back into their business. The result is often higher profits and therefore higher potential capital gains, but it does come at greater risk. Business ventures can fail and prices often prove to be more volatile. Another key factor to account for is dividends. Income from equity investments can be an important part of an investor's portfolio. The ASX 200's indicative dividend yield currently sits at 3.86%, while indicative yield for the S&P 500 is only 1.35%. Again, the nature of these indices explain this difference. Australia's blue chips like to pay out their profits as dividends, whereas the S&P 500's largest companies often reinvest their profits back into the business for further growth. So there you have it. The ASX 200 and the S&P 500 both have some unique benefits, and depending on how much you value those benefits in a portfolio will depend on how much you invest in each. But keep an eye on home buyers. And for more information to help set you up on your lifelong investment journey, subscribe to the channel. Bye for now.